Greetings, everyone. Today, I want us to look at the techniques of financial forecasting. Last time, we looked at the various steps or the process that we involve in financial forecasting. Today, I want us to look at the methods or the techniques that we do utilize in financial forecasting. We said financial forecasting is estimating the future financial outcomes for the company. And we normally do this for purposes of projections, for the profit, the loss, cash flow forecasts, burn rates, etc. So the first technique that we use is making use of the cash budget. And a cash budget is a financial statement that indicates the sources of revenue and the capital cash inflow of a business entity. It also assists in knowing how the inflows will be expended to meet the revenue and the capital expenditure. Of course, if there are any anticipated cash deficits or supply, then they'll help in forecasting for the period under budget. So the major role of the cash budget is to determine the cash surplus or deficit. It is also used to plan because the company is able to know what is needed or what resources are tied to which particular period. And if there are any deficit, they'll be in a position to plan for the deficit. So they'll not be caught up in the surprises. So it will be used to enable the management to control the expenses by avoiding wastages or leverage during operations. And of course, to the employees, when they know they are working towards a target, we normally talk of the performance dashboard. Employees will be working towards achieving that particular target, and it becomes very easy when they are working towards a target, and especially if most companies will normally give a bonus if the targets are met. So this helps really to improve the morale of the employees. So the cash budget deals with only cash items, and therefore you may be utilizing other techniques because of the other items that will be in need of forecasting or establishing for the business. For example, if you're in need of spontaneous financing, or if we are in need of, let's say, getting external financing. Let's say the company decides to take an external debt, let's say in form of commercial papers. That will be aided by use of the other techniques like the percentage of sale method. So I want to bring an illustration of cash. I've shared this in the portal. You are training in the finance department of Baraka Limited, and the head of department has requested you to prepare a cash budget for January, February, and March of the year 2021. So you've been given the actual revenues and costs spanning from September all the way to March. And the figures are given there. You got the figures for sales, wages, material purchases, and overheads. So you've been given for September, October, November, December for the year 2020. And for the year 2021, you've been given for the duration January to April. Normally, you'll be given some historical data to help you make a decision or to make you understand the underlying cases should you require to make use of the historical data. Now, we've been given additional information there. Well, I think this question will be better in, let me put it in the Excel sheet. So I've shared that question in the Excel sheet for purposes of maneuvering on the question. So we've been told that it is expected that we are in the additional information number 1 here. We've been told it is expected that the cash balance on 31st December 2020 will be 2.2 million. So that will be our balance carried downward. Then no, brought downward because it was carried downward in 2020. We are planning for 2021. Then we have the overdraft facilities. They are available as and when they are required. So you'll see that. So should the company or should Baraka Limited go short of cash, they can always go for an overdraft. But this will tell. Then we have the number 3. The company pays the wages on the last day of the month. So they are paying in arrears. So they wait for the month to end. Then on the last day of the month, for instance, the wages for January will be paid on 31st January. February will be paid on 28th of February, like that. Then number 4 is the company's policy to pay creditors 3 months after receipts of supplies. So we are looking at the creditors. Let me see. So you have the materials purchases. And when we purchase, assuming we are using credit terms, then these will be our creditors. So we are talking of the company pays with, no, number 4, it is the company's policy to pay the creditors 3 months after the receipt of supplies. So we are budgeting for the duration between January and March. So we'll be working, so on January, we'll be receiving the 3 months down the line. So we'll be talking of the October. So the creditors for October are the ones who will be paid in the month of January. Then February will be paying the ones due in November, and then December, the one due in will be paid in March, and like that. Then 5, 10% of the monthly sales are for cash, while the balance are sold on credit. Debtors are expected to pay 2 months after the delivery of goods. So 10% of the sales. So you'll be looking at the sales. Then number 6, included in the overheads is 200,000 per month, representing the depreciation of motor vehicles. So there is 1 month delay in paying overhead expenses. We'll be coming to that. A commission of 5% is paid to sales agent on sales on credit. The payment of the commission is made in the month following that of sale. So this commission has not been included in the overhead expenses. And then delivery is expected in February 2021 of a new machine that was acquired at 4.5 million, of which 1.5 will be paid on delivery. That is February, and 1.5 in each of the following 2 months. So in the subsequent month, that is March and April. So I said that a cash budget deals in cash. So I want us to account for the cash and allow me to work from this end. So I'll be working for the month of September. You can just work for all the months. So September, October, November, December, Jan, Feb, March, and we have April. For the cash, we can account for all the cash. So I'm talking of the cash sales. So we can see we've been told that that was number 5. 10% of the monthly sales are for cash, while the balance are sold on credit. So the sales that we are seeing here in this column, they are for credit, but 10% of it is cash sales. So you can go together. So in the month of September, I have 3,000, so 10% will be 300. In the month of October, I have 400, 4,400 will be 10%. Then November, 600 will be 10%. December, 500 will be 10%. January, 7,700 is 10%. Feb, 6,600 will be 10%. March, 5,500 will be, and then April, 5,500 will be the 10%. So what do you remain with? What remains is our credit sales. And the reason why I'm doing the credit sales is because there is a rider. We've been told that 10% of the monthly sales are cash, while the balance are sold on credit. Debtors then are expected to be paid 2 months after the delivery of the goods. But number 7 is talking of a commission of 5% is paid to sales agent on all sales on credit, right? So I'll be doing that. I'll be getting the difference. So this will be 3,000 minus 300, 27. 4,000 minus that will be 36. 6,000 minus 6 will be 54. 5,000 minus 500, 45. 7,000 minus 700 is 63. Then 6,000 minus 600 is 54. 5,000 minus 500 is 45. And 5,000 minus 500 is 45. So I got my credit sales. Number 7 is saying a commission of 5%. So I'll be getting 5% commission. 5% commission out of this. I want you to get me the figures. So 5% here is 135. 5% of 36, I'm getting 180. 5%, 270. 5%, 225. Can confirm these figures. 5%, 315. 5%, 270. 5%, 225. 5%, 225. So I've been able to get that, right? So these are the figures. Let me just put them in. Let me paint them because they are not part of the question. Well, I already have my cash, so I can start doing my question. So we are getting, or we are making the let me see what I can work from here. For purposes of space, we just cut this and print it, post it somewhere there so that I can work here, right? So what I'm doing is the cash budget. So Baraka Limited, cash budget, well, for the months of Jan to, been told Jan to March, right? 2021. So I'll need to get the items. So we start with the, I can have the 3 months here. So I'm talking of January, Feb, and March. should be the other cell. So these are the items. So I start with the balance that was brought downward from 2020. My figures will be in thousands. So I was told it's expected that the cash balance is 2.2. So I'll use 2,200. I go on. Then from there, I'll put all the receipts. And the first in the receipts are my cash sales because I have them here. So let me start with cash sales. So cash sales for January is 700, 600, 500, right? So I go on after the cash sales. I have the other receipts will be coming from debtors. Look at number 5. Number 5 is here. I've been told that 10% of the monthly sales for the cash, while the balance are sold on credit. Debtors are expected to pay 2 months after the delivery of goods. So we are paying 2 months after the delivery of goods. So this is the goods column. I have the purchases. So after we receive the goods, we are paying 2 months. So in January, we'll be having the payment for which month? Which debtors will be paid for that particular month? This will be the debtors for November, isn't it? So I'll be looking for, let me see, 10% of the cash while the balance is sold on credit. Debtors are expected to pay. So we are talking of the credit sales. Debtors are paying us 2 months after. So in January, we'll be getting the payment, or we'll be receiving the payment that is due in November. So debtors. So November 5/4 will be paid in January. Then December 4/5 will be paid in Feb. And then 6/3 will be paid in March, right? Any other receipts? I leave some space. Should there be any other receipts? So let me go to the payments. Cash budget is all about what you are receiving and what you are paying. And in the payment, we start with wages. Number 3, the company pays the wages on the last day. So I start with wages. Last day means same month, but the last day. So wages for January is 1,2. For Feb is 1,000. For March is wages. Yeah, for month is 900, right? So that is wages. Then we go to number 4. Is the company's policy to pay creditors 3 months after the receipts of supplies. 3 months after the receipts of supplies. So we are talking of the material purchases. These are our creditors. We are paying 3 months after receipts. To mean, in January, we'll be paying for the merchandise, all the materials that were purchased in the month of September. Isn't that so? So I'm talking of the creditors payments. So we are talking of 3,000. Then 3 months, 2,500 due in November, and then 3,500 due in December, right? Those are creditors. We are paying 3 months after the purchase. Then number 5, we've dealt with that. Number 6, included in the overheads is 200,000 per month, representing depreciation on motor vehicles. So depreciation is a non-cash. We need to deduct it. So there is a 1 month delay in paying the overhead expenses. So what we'll do, we'll go to the expenses column. We are being told that we have a 1 month delay, right? There is a 1 month delay in paying the overheads, which means in January, we'll be paying the overheads that were due in December. But remember, there is a depreciation of 200, which is non-cash. So we'll be doing 1,400 or 1,400,000 minus 200, will be left with 1.2. So for February, we'll be paying what is due for January, we'll be paying 18. So it will be paid in February. So that will be 1.6. And then for the month of March, we'll be paying what is due in Feb minus 200. That will be 1.4. Correct? Those are overheads. Then I go to number 7. There is a commission that we paid. We had already calculated the commission, but there is a rider. We've been told a commission of 5% is paid to sales agent on sales made on credit. The payment of commission is made in the month following that of sale. This commission has not been included in the overhead. That is why we accounted for it. So I have commission to mean in the month of January, I'll be paying what was due in December, right? In the month of January, I'm paying what is due in December. I'll be paying 225. In the month of Feb, I'll be paying what is due in January, 315. And in the month of Feb, I'll be paying what is due in January, which is, no, in the month of March, I'll be paying what is due in Feb, which is 270. I think that is okay. That is number 7. Then number 8, delivery is expected in February 2021 of a new machine costing 4.5, of which 1.5 will be paid on delivery and shillings 1.5 in each of the following 2 months, which means in the month of, so we are talking of the payment or the purchase. Let me just say purchase of new machine. I'll just cut it. So we are talking of, we are purchasing in February, and during the month of purchase, we are paying 1.5, and the subsequent month 1.5. So we won't pay anything in the month of January. Our date of acquisition is, I think we are done with the additional information, and there is no any other receipts or payment that we haven't accounted for. So this is how the cash budget will look like. So our total receipts, let me just call it total A, is this. So that gives me 83. Let me just put the formula. It's equal to the sum of this, so that I can copy the formula in the subsequent cells. And this is 0. So this is equals to total B. So total B is equal to the sum of this cell all the way to this. And then I scroll the formula. So what we need to do is we want to know the deficit or the surplus by subtracting total A minus B. That's what will be giving us the deficit or the surplus. So I'm talking of this cell minus this cell. Then I can scroll. But can see we are getting a negative. But you can see in the month of January, we have a surplus. So a surplus of 2,000. Let me make this money. Doesn't look like money. So we have our figures are in thousands. So you can see we have a surplus of 2,675,000. So this becomes our balance brought downward in the month of February. So 2675, right? So again, we work through. So you can see we are getting, me bolden these figures. So you can see we are getting a balance of, we are getting a surplus balance in the month of February. So a surplus balance becomes our, had it been an overdraft, would have gone to additional information number 2, where we are told overdraft facilities are available if and when required. But because we don't have a deficit, we carry it forward. So we have a balance brought downward of again 860. So that becomes our, this is the cash budget for, this is the cash budget for this particular farm, which is Baraka Limited. So what you need to know is that you have to follow the information as it has been provided, because that information is what guides you in interpreting the, especially the additional information. It helps you now in interpreting the breakdown or what the farm aspires to do. So that is the cash budget. They'll occur in different designs, but that is the case that was given to the trainee who was on attachment. So this is what the trainee ought to have done. Should there be any question, can be dropped. So I want to revert to the notes and bring another technique. So I'll stop sharing and I go back to my notes. So we've done this illustration. The other method is the regression method. And regression method, we won't cover it at this stage because you covered it in your cost accounting. But regression method is a stochastic or a statistical method which involves the identification of the dependent and the independent. And we work on the linear regression equation, y is equal to a plus b plus x, where x is our independent variable. This is our independent variable. Y depends on x, so it becomes the dependent variable. A is the y-intercept, or where the linear or the equation line, the linear, the line or the curve cuts the y-axis. And then B is the slope or the gradient of the line. So again, we can use that technique to help us forecast. So I want us to look at the third one, which is the percentage of sales method. Percentage of sales method involves expressing the various balance sheet items that are directly related to sales as a percentage of sales. If you recall the common size method, when you are trying to look at how we analyze the company's situation, or how we do the analysis, one of the technique was common size. And common size was making use of one item of the income statement, which is the sales, and you are using sales in this case. And the balance sheet, you are using total assets as the element out of which all the other items will be rated. or you'll be getting the percentage off. But you can see things have changed a bit. So in the percentage of sales method here, we are saying that we are going to use sales as a percentage. So the method expresses the balance sheet items that are directly related to sales. And in our common size, the balance sheet was using total assets. So don't confuse the two. For the percentage of sales method, yes, we are using the balance sheet line items, but we are using sales as our basis or our base, our reference point. So there are several steps that are followed. The first one is to identify the various balance sheet items that are directly related to the sales. And this includes the net fixed assets. We know that the non-current assets are the resources that will be tied by the owners of the business for purposes of generating revenue. Then we have the current assets. These are short-term obligations. Then we have the current liabilities. We know these are obligations that are, no, current assets are short-term resources that the business will tie to generate revenue. It's not moving. Let me leave it at that point. Then we have the current liabilities. Current liabilities are obligations that the business need to meet. So increased sales will lead to purchase of more new materials, which means more liabilities. So they are affecting sales. Then you have the retained earnings. Most businesses will not distribute all their profits. So most of the profit, some of the profit will be retained as reserve for purposes of, there could be emergencies, or the company maybe needs to buy some capital assets for expansion or something of the sort. So they are not going to distribute all their earnings. So the retained earnings will increase sales if and only the firm is operating profitably. Should there be a loss, then we will not retain. Even for the obligations like taxes need to be deferred because we cannot be able to pay. So kindly note that. So there is a note before down there. Increase in sales does not require an increase in ordinary share capital. So we don't need to sell our securities to increase sales. Then the step number 2 is to express the various balance sheet items. The balance sheet items that we have identified up there, the net fixed assets, the current assets, the current liabilities, and the retained earnings will be now be expressed as a percentage of sales. I have an example here. Assume for the year 2002, stock and fixed assets amounted to 12 million and 18 million respectively. Then sales amount was 40 million. Therefore, the stock as a percentage of sales will be 12 over 40 million multiplied by 100. And that is giving us 30%. And then we have the fixed assets as a percentage of sales will be 18 million over 40 million multiplied by 100. We are getting 45. So that is the step number 2. So step number 1, we identified the items that are related to sales. Then we convert them to a percentage of sales. Then step number 3, we determine whether it's an increase in the total asset or a decrease. So determine the increase in the total assets as a result of increased sales. We want to know how did they impact on the sales. Now, suppose in our case, number 2, where we've said that our fixed assets were 12 million and 18 million, suppose sales increased from 40 million to 60 million. What will be the ripple effect? It means the additional stock and the net fixed assets would also be affected. So we know that the increase in the stock is 30%. We are increasing our sales from 40 to 60. So the net effect will be 30% of 60 million minus 40 million. So 30% of 20 million is 6 million. And for the fixed assets, we'll be moving now from, we have 45%, we'll be moving now 45% of 40 to 60. Again, 45% of 60 minus 40 gives us 9 million. I think that is clear enough. Then step number 4. Now we have checked at the net effect if the sales increase. Then determine the total increase in assets, which will be financed either by what we call the spontaneous source of income. So we'll be looking at the increase in the current liabilities, where the increase will be equal to the percentage of sales multiplied by the increase in sales, right? And then we'll want to know whether to get that money from the retained earnings. So we can either get it from our spontaneous source of finance, could be short-term or could be an overdraft like the one that Baraka was accessing from the banker, or in some cases we may need to borrow externally. And externally you can use various instruments. I had given an example of commercial papers. We'll have an example and see. So we'll be looking at the spontaneous. I've explained how we get the spontaneous source of finance. We look at the percentage of sales, we multiply by the increase in the sales. And then for the retained earnings are obtained by net profit minus dividends, or what we call the net profit margin. Net profit margin is net profit over sales, right? What you need to know is that we can express now our net profit in form of net profit margin and sales. So net profit will be net profit margin multiplied by sales. Now we call these the after-tax returns. So the net profit margin is known as the after-tax return. So this one can be used sometimes by the examiner to see whether you understand the ratios. Kindly note that. So this model works under some assumptions. It's a model, I say. So these are the assumptions of the percentage of sales method. So the fundamental assumption is that the percentage of sales is that there will be no inflation in the economy. Well, it's an assumption because we know what you call the aggregate price levels are affected by the forces of demand and supply. There are other macroeconomic determinants like fiscal policy, monetary policy, etc. But for this case, for the percentage of sales method to apply, we assume that there is no inflation. Then we have other assumptions. We assume that we have what we call the classical optimization, where the farm or the business is operating at 100% capacity. So there are no chances of pilferage or wastages. We are utilizing our fixed asset 100%. Then number 3 or number 2, the firm will not issue new ordinary shares. So we said we are riding on sales, and therefore we'll assume that we are not selling any or increasing our capital in form of selling the different classes of securities. Then we have number 3, the relationship between balance sheet items and sales. We are taking the balance sheet items as a percentage of sales, and this will be maintained all through the forecasting period. And lastly, the after-tax profit on sales or net profit margin will be achieved and shall remain constant during the forecasting period. So those are the assumptions that underlie the percentage of sales method. I have an illustration here. I can carry this illustration for, let me carry it to the, so I'll stop sharing this and go to the, I'm not sure whether I have carried it. Let me share it in the Excel. Can use a different sheet. Paste. Wonderful. I don't know why I can delete this. So let me just take this here to align. This here to align. Very well. So I have my example here, the illustration. We've been told that this is the balance sheet of XYZ Limited as at 31st December 2012. Net fixed asset 300. Then we have all the other balance sheet items. Ordinary share capital. I have the, let me not distort the arrangement. I have the retained earnings. I have the debentures, and I have the trade creditors, and I have the accrued expenses. So I want us to use the percentage of sales method. And we've said we are going to follow some steps. The first step is to identify the various items in the balance sheet that are related to sales. So we have the, you can see we have the net fixed asset is one. We have the current assets is the other. Let me color them. So I have these two. Ordinary share capital, no. Retained earnings, no. Debentures, no. So I have the liabilities again down here. Let me color them. So those are the four items that are related to sales. So the next step, or step number 2, is to express them, or to express the items that we have indicated as a percentage of sales. So let me, as a percentage of sales, that's the step number 2. So they are here. Let me paste them here. Then I have this. Let me paste them here. Well, we have them there. Then our sales are sales. Right, there's the figure for sales. In the additional information, you've been told here that the sales are 500 for the year 2012. So sales is 500 for the year 2012. We haven't moved yet. So this is the percentage of sales. So the percentage of sales will be 300 over 500 multiplied by 100. 300 over 500. So is equal to 300 divided by 500 multiplied by 100. Don't know why I'm not getting the answer. Did I do the right thing? So to get the percentage, it will be 300 millions over 500 multiplied by 100%, right? So that will give me 60%. Then this will be 100 over 500, 20%. 50 over 500, that will be 10%. Then 30 over 500, that is 6%, right? So I have expressed my elements in form of, or as a percentage of sales. That is the step number 2. Step number 3, you said, is to now compute the increase in sales over the period. And we've been given here that the sales will increase by 15% during the year 2013 and 10% during the year 2014. So we are talking of the increase. So we are increasing our 500,000 multiplied by 110 over 100. That is like 1.1. So that will give me 500 multiplied by 1.1. That is giving me 1.15. It's 15%. So that is giving me 115 over 100 over, that is giving me 575. So I get 575 million. And then the second one is on the sales for 2014. So the sales for 2014 is increasing by 10%. So this will be my base year. So this is my 2013. So for the 2014, it will be 575 multiplied by 1.1. They are increasing by 10%. So that will be 632. So 632.5 million. 632.5 million. So that is my step number 3. The last step, which is step number 4, is to know whether I may need the, so we can tell here the increase in sales. You are looking for the increase in sale. So the increase, let me just indicate it here. Increase in sale. So we are looking for the duration between 2014, 2012 to 2014. So 2012 we had, and work it here. So it will be 632.5 minus 2012, I had 500 million, right? So the difference will be 132.5 million. That is the difference, or that is the increase. Because this is what we'll need to know whether we are going to get spontaneous external funding, or we are going to get the money from the retained earnings. So that becomes our step number 4, and it is the last step. So step number 4. So I'm looking for to compute the external requirement for this farm in the 2 years. That is the year 2013 and the year 2014. So we can look at the increase in fixed assets. And the increase in fixed assets will be, as fixed asset was 60%. So I'm talking of 60% multiplied by 132.5 million to get the spontaneous capital, or the spontaneous amount that I need. That will give me 79.5. So I'm getting 75.5. Then I'll be looking at the increase in current assets. Current assets were increasing by 20%. So 20% of 132.5 million. I'm getting 26.5 million. So in other words, my total increase will be, I'll need to add these two, 79.500. This is 106 million. So I'm getting 106 million. So this is the additional investment that will be required in form of assets for XYZ Limited, So you can see how the percentage of sales method is able to help us reach at the required or the additional investment that may be required by the company. There is a second question, and the second question is asking, prepare a pro forma balance sheet. Prepare a pro forma, this should be balance sheet. Prepare a pro forma balance sheet as at 31st December. So you can prepare the pro forma balance sheet. Can make use of this space again. So this is the working. Let me distinguish it from the question. Let me just paint it yellow. Let me just paint it yellow. So I need to prepare the pro forma balance sheet. And a pro forma balance sheet is a projected balance sheet for the forecasting period. And we'll normally do this. We know that the additional capital that is required is 106. So actually we are trying to see how this 160 will be presented in the projected balance sheet as at the end of the forecasting period. So we'll start with the additional investment required. So additional, so let me do it here. Additional investment. And the additional investment required, we all know, is 106. So I require 106 million, right? So I want to know, out of this 106, when I meet all my obligations, because we've had an increase in the total creditors and an increase in the expenses, what will be needed to be funded either from the retained earnings, because I have them, or after I get everything, are my retained earnings able to cater for the spontaneous need in the additional investment? That's what I'm trying to check. So I'll start with looking at the increase in trade creditors. So there was increase. So I'm going to less. So I less that figure. Increase in trade creditors. The good thing is we had accounted for everything. So our increase was 10%, right? Our increase was 10%. So what is 10% of 132,500? 10% of 132,500. Let me just work it out here. Just pick this. But this time I'm looking for 10%. So 10% of 132 giving me 13 point. Should I work it here now? So 13.25. I'm going to subtract that figure from the 106. Let me omit the M so that the numbers can work for me. So I'm talking of millions, right? So 106 minus 13.25, because I'm lessing this figure. So I'm getting, or let me just less of them, all of them. Then I have the increase in accrued expenses. So I'll again less that. Increase in accrued expenses. Increase in accrued, let me just write accrued expenses. They are increasing by 6%. So I'm talking of 6% 6% of 132,500. I'm getting 7.95. 7.95. I'm getting 7.95. I just put this amount to avoid the confusion. Let me put them in thousands. So this will be 106. Let these figures be in thousand. See, the machine is already. So let the figure be in thousand so that I can convert this into. So we are talking of thousands. For easier computation. So that this becomes 13,250,000. This is 7,950,000. I think that is better now. That becomes better. So I have the increase. So from that additional investment, to know whether I need the external financing, I have the retained earnings here. So you can see I have retained earnings. And for the 2 years, I'll need to know because there is an increase. We've been told that the retained earnings, our net profit margin, to get the retained earnings, I said retained earnings is either given by the net profit minus dividends. So you can see we are paying a dividend of the after-tax return. You can see our net profit margin is 12%, which shall be maintained in future. So that one we know. Then the company's dividend is 80%, and this is again being maintained during the forecasting period. And then any additional financial will be through the commercial paper. Now you can see. So there could be, but you are going to check. I don't want to preempt. So let us less the, so we less, let me indicate here. Then we less. So I'll now less the, let me less the retained earnings. So the retained earnings, let me abbreviate them as RE. So our retained earnings, we've been told is 12%. So I'm getting 12% of the sales, right? And my sales, this is for the duration of 2013. My sales is 575. So I'll be getting 12% of 575. 10% of 575, what do I get? Let me write that figure here because I don't want to transfer it there. I'm getting 69,000 because I'll want to subtract first the dividends. I'll first to subtract the dividends first. So if I subtract the dividends, my dividends are 80%. So we are talking of 80% of 69. So 80% of retained earnings, which is 69,000. So that figure, the figure I'm getting is 55,200. So 69 minus 55,200, I'm getting 13,800. 13,800. So I'm able to get the retained earnings, and that is for 20. This is for 2013. So I'll need to do the same process. Let me copy paste this. It's easier. For the year 20. So this is for 20. To be elaborate, let me just cut all this. So this is for the year 2013. Accountants are supposed to be ordering. This is for the year 2014. So for the 2014, I'll be working with the increased figures. So the increased figures was 632.5, right? So 632,500, and I'll getting 75. Let me wrap this. 75,900. And then the last one, I have the 80% of 75,900. 75,900, I'm getting 60,720. So 75,900 minus, I'm lessing this figure. So 75,900 minus 60,720, I'm able to get 15,180. 15,180. Right? So all these figures, I want to deduct them to see whether I'm going to get I'm going to fully cater for my additional investment, or I may require to go ahead and get the amount from what we are calling the external financing in form of the commercial papers. There it is. I'm getting 55,820. What does that mean? It's a surplus. So this is the amount that I need to get from external financing. External financing. So you can see how I'm able to establish the amount that I get from external financing. And this external financing are occurring in form of commercial papers. So there I am. We are getting that from the, let me paint this, commercial papers. So this is what we are getting from the commercial papers. So the only other thing that you are supposed to do is to do the pro forma. You've been asked to give the pro forma balance sheet as at 31st December 2014. And what the pro forma balance sheet will do is actually to prove the figures that we have worked. So it becomes so easy for us now to prove. I'll start with the net fixed assets. Our next fixed asset is 60%, right? So what is 60% of 632.5? 60% of 632. I want to see the figures here because I'm trying to prove now. So we are doing the pro forma. So what is 60% of 632? This is our increase. So 60% of 632,500. 632,500,000. So 60%, I'm getting 379.5. So if you look at the, you can work it this way. You can see our increase was 79.5, right? Let me just write it here. Let me just write this for here to avoid the confusion. Is it that for? No, I want to put all these figures. Fixed assets. Let me carry all this. Let me put them here. want to I don't want these two. I can just take this. I'm just redoing the balance sheet, but this time I'm doing it with the increased figures, right? It's a pro forma balance sheet. So I'm taking 6%, 60% of 632. I've been able to get 379.5 million. That is 60% of 632,500. You can check. You're getting 379, which is same as I had 300. If you look at my balance sheet, I had 300. So if I add the increment, which is 79.5, I'm going to get 379.5. I'm just checking. I go to the current assets. The current assets increased by 20%. So 20% of 632,500. 20% of 632,500. 20% of 632,500. I'm getting 126.5. If you check, I have 100 plus 26.5 million. So it becomes to 126,500. So I'll add these two. That is 506, 506. So 506. I go on. Then ordinary shares are not changing, so they are remaining at 100. Then retained earnings are changing because we have worked on the increase of 12% and that of, so the year changes are here. So it's like I'm talking of 70 million plus 13.8 plus 15,180. So 70 plus 13.8 plus 15,180. I'm getting 98.98. 98.98. Even this figure is supposed to be pushed at the, anyway. I'm trying to be orderly here. So this is not moving. So this is my 100. It has moved. Then I have the 10% debentures. Debentures are not moving, so they are remaining the same. So debentures are not moving, they are remaining the same. So 150, let me rewrite. Then we go to the trade creditors. Trade creditors was 10% of 632,500. 10% of 632,500 is 63,250,000. So 63.25. And then I have the accrued expenses. They were 6%. 6% of 632,500. 6% of 632. I'm getting accrued expenses. I'm getting, that is 7.95. Well, there is no challenge because this one I can check. You can see our increment was our increase in accrued expense. What was the increase in the accrued expense? Our increase was 13.25. So 13.25 plus 50 will get the 63.25, right? Oh no. These figures are, this is supposed to be here. Sorry. So this was 150. I think I was missing one figure. So I was trying to explain the increase in the trade creditors. The increase was 13.25 million. I originally had 50 million. 50 million plus 13.25, I'm getting 63.25. The last one is accrued expense, which increased by 6%. 6% of 132, 6% of 632 is giving me 37.95. We can check. Our increase here was 7.95 million, and I had 30 million. 30 million plus 7,950,000, I'm getting 37.95 million. Are we there? And then the last one was the commercial paper. When I worked on the external financing, I got 55.82 million. So this is the external financing. I'll just write here commercial paper. And I'm crossing my fingers to see whether my balance sheet will balance. So commercial papers. So this is 55.82. So I got 506 million. 506. I want to add this. Sure, I'm getting 506 million. So the pro forma balance has balance. As I said, these are just a check because you are working backward. You would expect that it should balance, shouldn't have a problem. That's why we are being asked to prepare the pro forma balance sheet. Let me just write it here, pro forma balance sheet. And this is as at, we prepare balance sheet as at a given period. So we are talking of as at 2014. So this is my pro forma balance sheet. And as you can see, it has balance. Any question can be posted in the portal in a position to respond. So that is the pro forma balance sheet. I'll be sharing this working on your end for purposes of guiding you in the revision. If there are any question, I've said the questions can be relayed in the portal, right? Have a good evening.